Every time the world feels like it's falling apart, one thing seems to shine brighter than ever: gold. When stock markets crash, currencies lose value, or central banks make sudden moves, investors around the globe turn their eyes to this ancient metal. But why? Why does gold, something humans dug up thousands of years ago, still control the emotions of billionaires, governments, and ordinary investors alike? Is this rush to buy gold during uncertain times a smart financial strategy? Or is it simply fear dressed up as wisdom? Uncertainty is the one thing financial markets hate more than anything else. When investors can't predict what's coming, whether it's a market crash, inflation surge, or geopolitical conflict, fear replaces confidence. And when fear rises, investors sell risky assets like stocks and cryptocurrencies and move their money into what they perceive as safer stores of value. This reaction is what economists call a flight to safety. We've seen it time and again throughout history. During the 2008 global financial crisis, when major banks collapsed and stock markets lost over 50% of their value, gold prices soared from around $800 per ounce in 2008 to over $1,900 by 2011, more than doubling in just 3 years. Investors simply didn't trust the financial system, and gold became a symbol of security. Fast forward to the 2020 COVID-19 pandemic. Global lockdowns froze economies, and central banks printed trillions to keep things afloat. Again, gold surged, reaching an all-time high of around $2,070 per ounce in August 2020. People feared both a market collapse and the devaluation of paper currencies due to excessive money printing. And even more recently, in 2024, a mix of high inflation, rising interest rates, and geopolitical tensions, from the Russia-Ukraine war to conflicts in the Middle East, pushed investors back toward gold once again. In times like these, the collective mindset is simple. If everything else feels unstable, gold feels safe. This is the essence of the flight to safety. When the future looks uncertain, investors don't just seek returns, they seek survival. And for centuries, gold has been the ultimate insurance policy against chaos. So why does gold hold this almost mythical reputation as a safe haven asset? It's not just tradition or superstition. There are real, fundamental reasons why investors turn to gold when everything else feels uncertain. Let's break down the 4 biggest ones: store of value, inflation hedge, lack of default risk, and limited supply. Number 1. Gold as a store of value. For thousands of years, gold has been trusted as a store of value. Unlike paper currencies, which can be printed endlessly or lose value over time, gold is tangible, scarce, and durable. It doesn't corrode, tarnish, or depend on any government or institution to maintain its worth. Think about this. In ancient Rome, 1 ounce of gold could buy you a fine toga and sandals, essentially the equivalent of a well-tailored suit today. Over 2,000 years later, that same ounce of gold, worth around $2,300 in 2025, still buys you a high-quality business suit. The purchasing power has remained remarkably consistent across millennia. And that's the kind of stability that investors crave when currencies and markets are in turmoil. This enduring value isn't an accident. Gold's rarity, universal acceptance, and physical beauty make it more than a commodity. It's a psychological anchor. When people lose faith in banks, governments, or even money itself, gold becomes the one asset they believe will hold its worth no matter what happens next. Number 2. Gold as a hedge against inflation. Another major reason investors rush to gold is its reputation as an inflation hedge. Inflation simply means that your money buys less over time. Your $100 today might only buy $80 worth of goods a few years from now. When prices rise and the value of currencies declines, gold often moves in the opposite direction. That's because gold is priced in dollars, and when the dollar weakens, gold typically strengthens. During the 1970s, when U.S. inflation averaged around 7% annually, Gold prices skyrocketed from $35 per ounce in 1971, when the U.S. left the gold standard, to over $800 by 1980. That's more than a 20-fold increase in less than a decade. Even in modern times, inflation shocks tend to push gold upward. Between 2021 and 2023, as inflation hit multi-decade highs across major economies, gold prices remained strong, not because it generates income, but because investors saw it as a way to protect purchasing power. When your currency buys less each year, holding gold feels like locking in stability amid monetary erosion. Number 3. No default risk. Here's another unique feature. Gold carries no default risk. Stocks can go to zero. Bonds depend on the issuer's ability to pay. Even currencies can collapse if a country faces hyperinflation or a sovereign debt crisis. But gold? It doesn't rely on anyone's promise or performance. In financial terms, that makes gold an asset without counterparty risk. If you own gold, you don't need to trust a central bank, a CEO, or a government. It's just you and the metal. That's why during extreme crises, like the 2008 financial meltdown, gold demand soared even when other assets tumbled. Investors wanted something that couldn't default, be diluted, or be frozen by a bank. This independence makes gold especially attractive during times of systemic stress. It's one of the few assets that remain valuable outside the financial system, and that psychological reassurance is priceless during panic. Number 4. Limited supply. Finally, there's the supply factor, and it's crucial. Unlike fiat money, which can be created with a few keystrokes, gold supply grows very slowly. All the gold ever mined in human history would fit into about 3 Olympic-sized swimming pools. Each year, mining adds only about 1.5 to 2% to the total global stock, far below the rate at which central banks can expand the money supply. That scarcity is what underpins gold's value. When something is finite and trusted, it naturally becomes a store of wealth. Even major central banks understand this. That's why they continue to hold thousands of tons of gold as part of their reserves. In fact, in recent years, central banks from emerging markets like China, India, and Turkey have been aggressively increasing their gold holdings to reduce dependence on the US dollar and hedge against global currency volatility. So when uncertainty spikes, whether due to inflation, war, or financial instability, the world doesn't suddenly discover gold. It simply returns to it. Gold has always been the ultimate financial fallback, an anchor in an ocean of uncertainty. If we look closely, the rush to buy gold during uncertain times isn't just about economics. It's about emotion. Markets are driven by people, and people are driven by fear and trust. When the future feels unpredictable, logic often takes a back seat and instincts take over. Gold doesn't just represent wealth. It represents security, control, and certainty in a world that suddenly feels uncertain. During crises, investors experience what psychologists call loss aversion, the tendency to fear losses more than we value gains. Studies show that losing $100 feels roughly twice as painful as the pleasure of gaining $100. This means when markets crash, people aren't necessarily trying to make money. They're desperately trying not to lose it. And gold, being tangible and historically reliable, becomes the emotional safe space for that fear. Then there's herd behavior, one of the strongest forces in markets. When people see headlines screaming, "Investors flock to gold," or see prices climbing rapidly, they often follow the crowd without analyzing fundamentals. It's a deeply human instinct. If everyone else is rushing to safety, we assume they must know something we don't. This fear of missing out, or in this case, fear of being left exposed, pushes even rational investors to join the gold-buying frenzy. A classic example of this happened during the 2020 pandemic. When global uncertainty peaked, retail investors flooded into gold ETFs, central banks boosted their reserves, and even casual investors started buying gold coins. The price surge was driven not only by fundamentals like monetary easing, but also by collective psychology. Gold wasn't just an investment. It became a symbol of survival. Behavioral biases also play a subtle but powerful role. Recency bias makes people overreact to recent events. If the market has just crashed, they expect it to keep crashing. After living through inflation, war headlines, or financial turmoil, gold becomes the obvious choice because it performed well the last time the world was in crisis. Investors anchor their decisions to the most recent memory of uncertainty. And let's not forget the illusion of control. In times of chaos, holding a physical gold bar or even seeing gold in your portfolio feels empowering. It's something real in a world full of digital, abstract money and volatile assets. That tactile sense of security gives investors psychological comfort. Even if, financially speaking, gold might not always deliver superior returns. Ultimately, people don't just buy gold because it's a good investment. They buy it because it feels safe. It satisfies both the rational desire to protect wealth and the emotional need to find stability when everything else feels like it's falling apart. So, the next time you see headlines shouting that everyone's rushing to buy gold, pause for a moment and ask yourself, am I acting out of fear or out of strategy? That's the real difference between reacting like the crowd and thinking like an investor. If you found this video helpful, hit that like button. It helps more people understand investing through calm, clear logic instead of panic. Don't forget to subscribe for more deep, easy-to-understand insights on finance, markets, and investing psychology. And tell me in the comments below, do you think gold still deserves its safe haven status, or is it just riding on reputation?